What is going on, fam? 1%, baby. Good move by joining this mentorship because you're not going to regret it. This will be the first, maybe it's not your first actually, but it will be the only and last mentorship you'll ever need in your entire life. So before we get into this video, I just want to clarify that you probably just watched Blake's mech model video, and now you're watching Patty's PDI video. So just to elaborate on that, Blake created the mech model, a while ago, which revolves around targeting unmitigated fair value gaps, unfilled 5 minutes, unfilled 15 minutes. The PDI model is still using the same exact foundations as the mech model. However, it's going to be targeting accumulation zone highs and accumulation zone lows, and I'll get into that. But I just want to clarify that these aren't different strategies, okay? This is still our inversion models. Blake and I trade this way every single day, and these are models that we look for every single day. They have the same win rate, really the same foundation completely. The way we determine our bias, drawn liquidity, and go about our entry remains exact same. However, sometimes the market gives us different conditions and different price action that might not be a day where you'll find the mech model because we're not creating let's say an unfilled fair value gap to target. And so we'll have like a PDI present itself, and I'll get into what that looks like, of course. But I just want to say that you're not strategy hopping by, trading mech and trading PDI. You're going to master both of these, and it's going to happen simultaneously really with market experience, because they both really help you establish the same narrative and go about trading the same way every single day. But you're going to see slight discrepancies in each, primarily with what we target, but the rest remains the same. And both these models are fucking OP. They play out all the time, and you don't need to be a genius to learn these, but you really do need to sit down and listen to what I tell you, listen to what Blake tells you, and you're going to be able to understand the markets really damn well. And you don't only have to use these the mech model and PDI for entries. I can also elaborate a little bit on this video about how you use it to determine higher time frame narratives and such, and bias. And so this is a really, really, really expansive mentorship. This isn't any surface level information. We're not giving you a strategy which you just pattern trade every single day. Like, hey, if you find this, take it. No, I'm going to truly show you how you're supposed to view the markets and how you're supposed to execute these models. That being said, welcome to PB 1% lesson number 2 PDI model. I hope this is lesson number 2, all right? Because the next model was lesson number 1. There should be lesson number 2. But let's get into this, baby. So first thing I want to go over, and let me just make sure this is all good. Perfect. Yeah. General overview. So the PDI model, the reason it's called PDI is because it stands for pre-distribution model. It's teaching you how to utilize AMD with IFEG. Nice little ring to it. And if you don't know what AMD is, I'll get into that. But the way I discovered this model, if you want a little backstory on this, was in 2023 during an NFP day. I realized that price, before it often delivered to the next draw on liquidity, would accumulate, right? It would lose some volume, it would manipulate into a certain key level, and then it would distribute. And so I put together a model that helps you catch that distribution move. And so that's the primary aspect of the PDI model. You're catching the distribution move. So let's get into that. So with the mech model, like I said, right, you have your basic leg right here. You come down, and then on this current trading leg, you take the highest time from inversion, targeting an unfilled 5 or an unfilled 15-minute fair value gap. Unfilled is the same as saying unmitigated, right? Now, as you can see, there's not much of a difference with the PDI model, except that with the PDI model, you have this accumulation period, which we then manipulate lower, and this would be like the same current trading leg. We're taking the highest time frame inversion of this leg in the manipulation leg to catch the distribution and target accumulation zone highs or lows and beyond, right? So this is just a visual demonstration side to side of what really it looks like. Obviously, this is very simplified, and I'll get into real trading examples. But first, I want to keep things simple. I feel like this is the best way to teach you guys. We start off with simple illustrations, and then we get a little bit more technical, showing you how it looks on the chart. And this helps you build that understanding. So first, let's start with what is AMD. And I don't care if you already know what AMD is, just listen to this, all right? Because it's going to help you solidify a better understanding of what accumulation, manipulation, distribution really is. So, like I just said, AMD is accumulation, manipulation, distribution. It is the three ways the market moves, okay? And so, usually, when price is accumulating, you'll notice these factors. We have low volatility price movement, lack of delivery, generation of liquidity, right? Liquidity up here or liquidity down here. Sideways price action, we call this consolidating, and we're stuck within a range, right? We're sort of stuck within like 50-point range, 40-point range. It could be whatever. And it happens typically after a very large move or in preparation for a large move. So I want you to remember that because those are really the two biggest times accumulation happens. If price distributes overnight, let's say 300 points, going into AM session will most likely have choppy price action because we're in an overextended range. And so volatility will die out for a bit before it then starts kicking in again. So that's what I mean after a very large move. And in preparation for a very large move, price usually accumulates before it hits a key level, and then you'll see a quick spike in volatility, which is that manipulation, which will trade into that key level, and then we'll distribute. So let's get into that. So like I said, accumulation, sideways price action. Manipulation, this is what I really, really, really want you to understand because this is what makes the PDI, and it's knowing how to identify manipulation. I need you guys to understand this so damn well. So manipulation is when price breaks out of the accumulation zone. It seeks liquidity or it seeks to rebalance a range. Okay, what does that mean? In other terms, it is looking to take out some significant sell side or buy side or to rebalance or hit an unfilled fair value gap, similar to MEC, right? So what MEC model will teach you is that prices, that's what what rebalancing ranges means. Price wants to mitigate these unfilled fair value gaps because those are imbalances in ranges. So when price is manipulating out of an accumulation zone, it's usually either seeking a significant liquidity pool or it's looking to rebalance an unfilled fair value gap. And so that means it'll typically trade into a higher time frame PD array, and that's what we consider a valid manipulation. If we see price break out of the accumulation and trade into like an hourly fair value gap, a 4-hour fair value gap, or if it sweeps like London lows, London highs, that's a valid manipulation. And I'll show you examples of that. And so the reason manipulation even works and the reason we've integrated it into the model is because what manipulation teaches you is that when the market is manipulating, it's trying to fake traders into buy or sells, right? So if you have price accumulating and then it breaks out of this range, what is the average retail trader going to think? Okay, we broke out of this accumulation lower, we're going to keep going lower. Wrong. That's manipulation, and it's trying to take out all the people here selling before it then actually delivers higher. So price manipulates out of the accumulation zone and trades into something of significance before reversing and distributing. This is the fake out move. Now, distribution. Price reverses after manipulating traders and it begins distributing in the correlated direction, right? So we have the accumulation, we manipulate lower, hit some sort of significant level, and then we distribute in the corresponding direction. So just really engrave this in your brain. Very simple what AMD is. You might have known what this is. You might have not. Anyways, I'm going to help you understand it even better, though. So the goal of PDI is to identify the manipulation leg, apply the inversion entry model, and catch the distribution phase. So if you haven't watched the videos we made, not only are we giving you guys like all this technical sauce and explaining our models and bias and drawing liquidities and rating setups, and the list goes on with everything we teach you. But we're also giving you the basics. So, if you need a refresher on inversions, on breaker blocks, on whatever it may be, all these basic concepts, I want you guys to watch those A through Z course videos. Whether you're a beginner or you're advanced, it doesn't hurt to just, look over those things again and, brush up on those. But anyways, like I said, the goal of PDI is to identify the manipulation leg after we break out of the accumulation and catch that inversion to catch the distribution phase. So how does that work? How do we know which inversion to take when we manipulate? So once the highest time frame for value gap of the manipulation leg has inversed, you can anticipate the distribution phase, right? So let's say we're accumulating here, we manipulate lower, we hit that key level, so maybe sweep London lows, maybe hit that hourly fair value gap. Now in that trading leg, that current trading leg that manipulated lower, we want to find whatever the highest time frame, in this case would be bearish fair value gap of this leg, to inverse would be. So let's say we come down and the highest time frame is a 3-minute bearish fair value gap. Then we simply want to wait for that 3-minute bearish value gap to inverse, and then we enter a trade, and you're able to catch the distribution phase. So with PDI, your first TP is always at accumulation zone high or low. You want to see all this low resistance liquidity get ran, or just the accumulation zone in general, wherever that high or low is of the accumulation zone. That's where you want your first TP to be. Because if we're truly in a lower time frame AMD, we should run that accumulation zone completely, right? Hope that makes sense. So now let's get into this. This is what it would look like, I guess, a full-fledged AMD, right? If you're like nearly catching low of day in a sense. And what this means, when you're catching a PDI like this, you've really nailed down every portion of time frame alignment. I will say, these aren't what most of your PDIs are going to look like. Yes, you will catch plenty of these, but since you are futures traders, you are intraday traders, and you're working to become profitable, I'm gonna teach you how to catch the piece of the pie, which is the most important thing, the most obvious. You don't need to catch a 1 to 10 R. That's bullshit. Whoever told you that it's bullshit. You don't need to catch a 1 to 5 R. You guys need to learn to understand that there's sacrifices that you make with the win rate and with risk to reward. You want high risk to reward, you will have a low win rate. You want high win rate, you will have a low risk to reward. We like to trade relatively lower RR with higher win rate, just because that's the most effective way of trading, especially with prop firms. So anyways, most of the time you're going to be taking your full TP at accumulation zone highs or lows, because it's the perfect piece of the pie. You get your 1 to 1, you get your 1 to 2, claim your profits, you're done for the day, you get off. Unless everything is truly in line, your higher time frame, your drawn liquidities, everything is perfectly fused for this trade, then you can leave those runners towards maybe the next buy side, maybe this buy side, maybe data highs, maybe previous day highs. But there needs to be a narrative for why you would leave a runner. So as you can see here, we have basic price action and bearish order flow, right? We're bearish, high, low, lower high, lower low, lower high, lower low, lower high, lower low. And then we start accumulating. We start accumulating after being bearish for a while, and then we mark out our accumulation zone highs, and we manipulate lower. What happens when we manipulate lower? We sweep London lows, and we hit a higher time frame Peter Ray, like an hourly fair value gap. So this is our manipulation, this leg right here. Now, what are we going to look for? The highest time frame fair value gap inverse in this leg. Let's say it's a 5-minute. That 5-minute gets inverse. Bang. We're entering here, and now we should be prepared for the distribution phase. If this was truly the manipulation leg, we shouldn't trade back to this low. So what happens? We enter here. Price trades to our accumulation zone highs. We should have about a 1 to 1 TP1 here, or full TP if bias isn't completely in line and we're not expecting price to just deliver all the way up. But if there's other confluence like data highs that look clean, then we can leave a runner. So TP1 is always accumulation zone high or low, because if we are truly about to enter a distribution phase, we should at least break out a buzz above the accumulation zone. The accumulation zone will often generate lots of low resistance liquidity, right? So this is accumulation zone. You'll see that it'll leave a lot of failure swings, but sometimes it doesn't. And we wait for it to be ran through before we break even / TP1. So I hope that makes sense. Before I get into the next slide. Now, what I just showed you was like the scenario where you leave a runner because there is a reason for price to run higher beyond the accumulation zone highs. We have those data highs, we have that previous day high, and the overall narrative seemed bullish, right? Now let's look at the PDI more internally. The PDI more internally would look something like this, right? If we're on the 1-minute time frame here, we have 1-minute chop, price is chopping up, we're generating some LR, we manipulate higher, we break out of this chop, and we hit like a 5-minute fair value gap. These are called conditions. And I'm going to get into that, I think, within the next 3 videos. I don't know exact order I put this in, but conditions video is going to be, I'd say, the most important video of this entire mentorship. It is what changed my entire trading completely. It is the uttermost fucking beautiful way to understand drawn liquidity and where the next one is, and so and so. So anyways, when you're trading PDI internally on the lower time frame and you start creating that 1 to 5 minute chop, all you need to confirm a PDI that a manipulation is a manipulation is you need the manipulation leg to trade into a 5 or 15 minute fair value gap, and then you take the highest time frame inversion of that manipulation leg. So let's say we're accumulating here. We want to take shorts to accumulation zone lows. Then we wait for price to break out of this accumulation zone, manipulate into this 5 minute bearish fair value gap. Awesome. We've hit that key level, that lower time frame key level. Now we take the highest time frame inversion at the manipulation leg. Cool. It's this 1 minute. We enter here. What do we target? Accumulation zone lows. Maybe we even have a MEC PDI here where below the accumulation zone lows is an unfilled 15 minute. So we can target that as well. Right? So that's awesome. And then let's say price distributes lower. And we go lower. Price starts accumulating again. Now we're accumulating. Price is generating this low resistance liquidity. We manipulate lower. This time we trade into an unfilled 15-minute fair value gap. Great. That's a lower time frame key level. That's a condition. We respect the 15-minute fair value gap. We get the highest time frame inversion at the manipulation leg to the upside. What do? We take profits at accumulation zone highs. We don't need to leave runners. In neither of these scenarios do we leave runners. Why? Because we're trading very internally right now. We don't really have a super strong higher time frame bias, but we're just taking the very obvious next drawn liquidity. Hope that makes sense. I'll get more into that in a second, and I'll show you real examples. So sometimes you have a scenario where price accumulates and then it breaks lower, and let's say you get an inversion right here. Don't be fooled, right? Because if it didn't manipulate into that higher time frame PDA or that key level, we're not ready to distribute, so you might get baited an inversion in this leg. But that's why I'm telling you not to pattern trade this. You need to really understand how this works, right? So we're accumulating here, we break out lower, and we're ignoring anything that's happening here because we haven't hit a key level, and then we hit that key level, we hit that higher time frame PD array, that 1 hour, 4 hour fair value gap, and then we take the entry of the inversion here. And this time we played a little bit different. We can break even at this internal high and then TP, full TP at that accumulation zone high. This is just an example, rare example, but it does happen. So the reason PDI is so helpful is because not only is it an incredible entry model system, but it's also a fucking phenomenal drawn liquidity indicator. So what I'm showing you here is what would look like a 15-minute chart versus a 1-minute chart, right? So this chop on the 15-minute would most likely look like this on the 1-minute. You see what I'm saying? And then this manipulation on the 15-minute would look like this manipulation on the 1-minute. And this inversion of the highest time frame fair value gap in this 15-minute time frame manipulation leg would most likely look like this on the 1-minute, right? So I'm just trying to scale down the time frames here because everything is fractal. What you can apply to on the 1-minute time frame, you can apply to on the 15-minute time frame, you can apply to on the hourly time frame. And so what I'm trying to get at here is that you can use PDI, pre-distribution inversion, to also be a drawn liquidity indicator. So if you notice that going into the morning, you had 15-minute chop, price breaks lower from this chop, and it inverses an hourly fair value gap or 15-minute fair value gap or something, whatever the highest time frame fair value gap is in the manipulation leg, then on the lower time frame, you're most likely going to enter a distribution phase. So you just want to wait for some lower time frame confirmation. What can that look like? So we know this, let's say this highest time frame fair value gap gets inverse. This gets inverse. Cool. We don't have to worry about anything blocking our way from getting higher here. So what do we wait for? A nice little pullback into a 5-minute fair value gap, inversions to the upside, bang, rip the trade, plays out. So that's that. And now I want to get into, I guess the more intricate parts. So let's go over a real day here of PDI. Let me just switch the screen here. Bang, bang, bang. Trading view. Boom, boom. Cool. Let's see here. Yep. Awesome. So This was Thursday, 26th of June. Since this is the 1%, since this, like, I'm trying to really show you guys these models and how efficient they are. I'm not out here like some fucking, you know, trash fake guru, whatever, on the internet, saucing you a model that maybe worked in like 2022. I'm telling you, this model has been back tested over years, and it continues to work over these years all the time. So this week of like the 25th, 24th, whatever, or the 26th, 25th, 24th, 23rd, I took maybe like 6 PDIs. All of them played out. Will it be like that all the time? No. Obviously, you're going to have losers, and especially while you're learning, you're going to have some losers. But this is going to show you a perfect example of how to trade PDI. So if we look here, going into the morning, let's look at this. Ready? So going into the morning, what do I realize? I see, okay, cool. You know, previous day high has already been taken. That's one thing to note. So we're most likely getting a reaction off that. And I also see that we swept London highs, and we're not displacing above London highs. So I'm thinking, we're looking pretty damn bearish, right? We're looking pretty damn bearish. And so now I want to confirm that with lower time frame confirmation. So I'm obviously not going to look to target London highs right now. I'm more so looking at London lows as the next draw. I see we have London lows. We have an unfilled 30-minute here. And we have an unfilled hourly down there, which it looks like it got traded into because I turned on the hourly chart. But so going into the morning, I see, okay, we got London lows right here. And we have this unfilled hourly down here. Awesome. Pre-market, I see that price is chopping up. So we're chopping. And if we were to manipulate into something higher, what would it be? We have this unfilled 15-minute fair value gap above. Okay, so this is valid, right? If we break higher here, we're most likely going to manipulate into this unmitigated fair value gap, this imbalance. And so I'm going to mark out my chop. Say, okay, cool, we're chopping here. This is going to be our accumulation zone. You know, if we're going to take a PDI, we target this accumulation zone low. So we can go accumulation zone low. And then I see, okay, we broke out of this accumulation. We manipulated higher at 9:30 open, which is even better confirmation. If 9:30 open is rejecting this level, then we know that this was a 9:30 Judas. What does that mean? It just means when 9:30 price opens in a certain direction, just to rebalance a range or seek some sort of liquidity before it goes in the corresponding direction and distributes. So here we notice that price accumulates, price manipulates, it breaks higher and hits this unfilled 15-minute. All right, that was the highest time frame unfilled gap that we had here, so it made perfect sense that price wanted to trade there. Now, what is going to be our highest time frame inversion to the downside in this manipulation leg? This is going to be our manipulation leg, so I want to find the highest time frame inversion. It's this 3-minute. Cool. So once we inverse this 3-minute, I can take shorts. But here's the twist. Well, there's no twist. But what I'm here to tell you is there a reason to take shorts beyond just accumulation zone lows and we have PDI? We can't just pattern trade it. Well, there is a reason to take shorts. We have London low still intact, and we have this unfilled hourly down here. So I wait here. I know I have a narrative behind this trade. I just want to wait for price to inverse this 3-minute, and then I'm locked in. So price inverses at 3-minute, bang. I'm getting my entry right here. Stop loss is at this body closure. And since I don't have a 1-to-1 towards accumulation zone lows, I'm going to make sure I break even there though, and then TP when I get about a 1-to-1. So after we hit accumulation zone lows, you know, I'm going break even here and taking a TP around here, and I get my 1-to-1. Seems like this trade would either be break even because it does wick back up. But notice how after it runs towards London lows, it runs towards unfilled hourly. Cool. So this distributes, right? After accumulating, manipulating, it distributes. And then you can see this on the 1 minute time frame. Price accumulates, manipulates higher. You get that high time frame inversion, and then it distributes. Here, maybe you could play it a little bit more discretionary just because you had like this here, so you could have like TP'd here, this very clean sell side. But nonetheless, you break even here, TP at 1-to-1 if you don't have a 1-to-1 at accumulation zone lows, and you get that with this candle anyways. And then what happens? Price starts, price distributes lower, right? Price distributes lower here. We sweep London lows, nice. We hit this unfilled hourly right here. This is going to be the unfilled hourly fair value gap. And then, like you can see on the hourly chart, right, we trade all the way down to here. Oop, I mixed it up. This is the devil's mark. I just wanted to mark this out because it swept it really clean. Devil's mark is just when a candle has no wick. So as you can see here, it takes that devil's mark. It also trades into this unfilled hourly fair value gap. And then we get a reaction off of that. So now what do you notice? When I was talking about PDI earlier, I told you it happens one of two times. It happens after a large move or in preparation for a large move, right? So since price has now distributed lower and we took out some liquidity, some significant liquidity like London lows, what happens? Price starts chopping again, okay? So we can identify that price starts chopping again right here. And what do we want to look for now? We want to look for price to break out of this chop, manipulate lower, and get the highest time frame inversion. How do we know if it's a valid manipulation? If it trades into a higher time frame key level. All right? So price breaks lower, and it hits this unfilled hourly. So now we know, okay, cool. This is our accumulation. Our accumulation zone high is going to be right here. And now all we want to find is that highest time frame inversion to the upside, in this case, at this manipulation leg. And so we see that we have this 1 minute. It's small, but it's there, right? So there's this 1 minute fair value gap here. That is the highest time frame fair value gap to inverse in this manipulation leg. And so we inverse it at this candle. We enter right here. What are we targeting, guys? Accumulation zone highs. And then if overall we're very bullish, what can we do? We can target high of day. Why? And why do I say in this case it's valid? Well, because we're at all-time highs PA. So this is actually a really good time to like low-key learn this model, because if we do see like going into the morning, we have some PDIs presenting themselves, or we have some accumulation manipulated into like higher time frame key level, and we're taking PDI longs, we can leave a runner towards all-time highs nearly every single time. And so all-time highs is going to be up here because we've been trading at all-time highs. So mark out all-time highs. Bang. And as you can see, price rips accumulation zone, TP1. You have about a 1, a 2, 1, a 3 there. And if you leave a runner to all-time highs, let's see if this hits. Slow and steady, but it does. Cool. So it distributes there. Price accumulates, manipulates lower, highest time frame 1 minute inversion down here. Hard to spot, but it's there. And then distribute higher. Accumulation zone highs, TP1. Leave a runner towards all-time highs, TP2. I just recommend you guys get in the habit of full TPing at accumulation zone highs or lows every single time, just so you can really master the model and the internal liquidity aspect of things. But yeah. And can anyone notice another PDI here? This is a bit hard to spot. But do you notice another PDI within here? I don't blame you if you don't. But let's look at this. What happens here after this pretty strong move with little to no retracement? So notice what happens here. Let's say we're trading around here. We haven't taken a trade yet. And we see, okay. Price just distributed 90 points with no retracement. And we just took out this buy side. I'm still pretty bullish though. So I'm not expecting for price to just flip bearish. Maybe I can take some continuation longs towards all-time highs. Do I have something that price can manipulate into? Let's see. Well, we have like this 5 minute here. So maybe we can manipulate into this 5 minute and catch some PDI longs again. Because what's happening after this large distribution move with no retracement, price starts accumulating. So price accumulates here. You can see that's sideways price action, that barcode looking price action. What do we get? It's going to be our accumulation zone highs right here. We hit this 5 minute, manipulate lower into this 5 minute because that's all you need for the PDI. And when you're trading internally, 5 or 15 minute, what's our highest time frame? It's going to be this 1 minute. And price inverses this 1 minute right there. Enter longs right here. Continuation model, PDI model, a little mix of both of those. And you get that nice distribution. Yeah, definitely some pretty choppy PA though on this day, but it plays out nice. And you know, you take your TP here, maybe leave a runner towards all-time highs, depending on how high conviction you have. But I hope you're noticing now really the power of this fucking model. And if anyone's thinking right now, oh, what about this PDI presenting itself? Well, now you're pattern trading. So let me give you a little bit of sauce. All-time highs is not a liquidity pool. When you take all-time highs, or when you trade to all-time highs, sure, you might get a little reaction, but all-time highs isn't liquidity. So just because we swept this all-time highs, you don't sweep shit. You don't sweep all-time highs, and you get a reaction. Don't be fooled by like an inversion to the downside. Remember, all-time highs, it's low-key better to be looking for longs. But if you have very obvious shorts, you can take very obvious shorts. This just isn't very obvious. We're not trading out we're not inside like a 1 hour bearish fair value gap or anything like that. So we're not looking at this, right? But let's say we did have we tapped into like an hourly, key level, an hourly PD ray, 1 hour bearish fair value gap, and then we had this setup present itself. Oof, now that would be a fucking PDI, with all this low resistance liquidity generated. Yeah, that would be beautiful, but that's not the case. So I don't know if like ES ran this, yeah. So don't be fooled by this. Now, these are some examples of PDI here, and I'm sure you can find them nearly every single day. Let's see, maybe see if we can find one Wednesday. If not, I'm just gonna go into some other examples. I'm on the 5 minute chart right here. I can see one off rip right here. If price accumulating, manipulates higher, 5 minute inversion to the downside. But did it manipulate into anything significant is a question. 30, 1 hour. So look at this. Look at this. Let's look at this. 1 hour fair value gap. So here I'm looking at the 5 minute chart. I see that, let me turn this off. I can clearly see that price has been accumulating and edging London lows, right? We have London lows as the red line right here. And so this happens very often where price will start accumulating near a significant liquidity pool. And so what do we see here? We have this unfilled hourly fair value gap above. And so after accumulating for a bit, before we run to London lows, price decides to manipulate higher into this hourly fair value gap, and then we get that inversion at the manipulation leg of the 5-minute. So what do? We enter here. Accumulation zone lows. It's going to be first TP. And then, well, in this case, you have London lows right there. So you could just break even at accumulation zone lows and full TP at London lows. And that plays out nice. It also sweeps Asia. Right, we have Asia lows right below too. So that's clean. That was during PM session. Let's see if we can find a PDI. As I say that, I'm literally fucking looking at one. So let's look at this. Bang. Notice here, 5-minute chart. What's happening here? Let's go on the higher time frame here real quick. So we're inside this daily bearish fair value gap. Cool. We're inside a higher time frame key level, that's for sure. And now I notice that going into 9:30 to New York session, we were previously accumulating right here. Price eventually breaks out of this accumulation, and I can see that we have a 5-minute fair value gap as the highest time frame fair value gap to inverse here. So once we inverse this 5-minute fair value gap, we are ready to take PDI shorts, pre-distribution inversion shorts, and target what? Accumulation zone lows. And so here, and actually remember I took this trade. And so here, all I'm waiting for is inversion of this 5-minute before I'm ready to execute shorts and enter for the PDI. And as you can see, eventually we get this nice close. And I like this close, and I'll tell you why. So a lot of people might be thinking, oh, but we swept this low. What did I say, guys? With PDI, you're targeting accumulation zone lows. So if you have a lot of low resistance liquidity generated in accumulation zone, you're expecting it to all get ran if you're going to be in a true distribution phase. This is helping you catch the distribution phase of an AMD model. So don't be discouraged if you just see this low get swept, because if we're truly in a distribution phase, we're going to run all of this. And as you can see here, after we swept this low, we come back up and we hit this 5-minute fair value gap. We react off of it, and then we inverse the 5-minute right here. So we play this like this. We can play this actually like this because this is the high that traded into the 5-minute, so we shouldn't go back to this high. And bang, there's your TP1. And let's say, I mean, I don't know really how bearish this, yeah, I would just full close there. Why? Because you hit this unfilled hourly. These are key levels. You're most definitely going to get a reaction off of this. So I would probably just full TP there and, you know, play it smart. So that was like a nice little 5-minute PDI. And this is why it's important to really change between these time frames, because here on the 5-minute you can see that it looks very clear, but on the 1-minute it's kind of like a bit all over the place. On the 1-minute it looks like this. You have your accumulation zone here. You have that sweep of that low, and then we trade back up into the 5-minute bearish fair value gap here. We respect it, and then we get that inversion to the downside. On the 5-minute, since this is the highest time frame, it looks really clean. Cool. So this is 10. Let's see if anything else PDI related kind of presents itself. Holy shit, it's like I can't even make this up. Anyways, let's see if this is a valid PDI though. Maybe it's not even a valid PDI. So what we're looking for here is we see that price has been accumulating for a while now, right? From 1017 to 1044. And in the process of accumulating, we're generating all this low resistance liquidity. Okay, cool. So we have this accumulation zone. We have all that liquidity being generated. Our accumulation zone low is going to be right here. And now we want to wait for a significant break from this accumulation zone and manipulation higher, and then an inversion to the downside to catch a distribution leg and target accumulation zone lows. But we need to find what could price manipulate into. From what I see, I don't really see much. So this is probably a case where I wouldn't take this PDI model. This is what I would consider pattern trading it, because like I can see that we maybe retested this 5-minute, but I wouldn't consider this 5-minute fair value gap that valid anymore because it already did its job. It delivered price towards this unfilled hourly fair value gap. And I'm also most likely not leaning too bearish anymore after seeing the reaction that we got from this hourly fair value gap getting traded into. So I'm probably not going to take this. So this is one of the cases where I would just sit this out and just watch price, just because I don't feel like this is the most valid manipulation. But I remember a lot of people in the Discord took this, which, you know, people build their own conviction with the model. Personally, I think this is sort of a pattern trade. And anyways, as you can see here, though, right, we accumulate, price breaks out. The only inversion there even is this beautiful 1 minute. And you can just target those accumulations on lows. And that plays nicely. Aside from that, I don't really see much else here. Let's see if there's another. Okay, so this might be actually a valid PDI. Does this end up hitting London or anything? Or does this chop up? We're probably going into lunch hour now. Yeah, it's a whole lot of chop. Whole lot of chop, a whole lot of chop. Yeah, so I don't trade these times. This is 11, this is lunch hour. I don't even look at that. Like I said, your primary window for PDI is going to be that 9:30 to 11. And so let's go over a few things here actually with PDI while we're at it. Let's go over this. So if we're trading inside of chop and you see some shit like this, a simple sweep of these lows, and yet we still have, let's say, a 5-minute fair value gap below right here. But we sweep these lows and we get an inversion right here. Are we taking this, targeting these accumulation zone highs? Answer is no. We're not going to take this. Why? Because we didn't manipulate into anything. We wanted to see this 5-minute fair value gap get traded into, and we couldn't do that. So in this case, we're not going to just take this little small breakout from the accumulation zone and sweep of these lows. We want to see price deliver lower, hit a 5 or 15-minute fair value gap as manipulation, and then we can take the inversion of this leg to the upside, bang, and that's that nice and valid PDI model. What else can we go over here? Also a bad example of taking PDI would be, don't just take PDI if this happens, right? If price is accumulating, but it creates a strong wick out of the accumulation zone and then it accumulates, and this strong wick hits, let's say, like a unfilled hourly or an unfilled 15-minute. Let me make this more clear here. Right? And then we break out lower and we get an inversion to the upside. This is no longer a valid accumulation because at one point during the accumulation, we manipulated higher and hit some sort of key level. And so we don't expect price to distribute higher here because this range has already been rebalanced, right? So there's not a narrative or reason for price to go higher here. Therefore, we're not just going to take this PDI because we have the entry if we know that the accumulation zone actually did something such as like rebalancing a range or swept some sort of important liquidity. That's also another thing to note. Now, here's the last thing I want to go over with PDI. And this is very, very, very fucking important. And this is time. You want to be able to utilize time to maximize PDI to its full potential. So what you'll realize is that often before a new hour candle opens up, price will chop. And so these are going to be these really high probability PDIs, where let's say, it's 9:30 to 10 right now. We're going to consider like the 9:30 to 10 right here. Let's mark this out. Sorry, 9:30 to 11, or 10:59 to be precise, is going to be what we're looking at right now. And what you'll notice is that price will start accumulating before a new hourly candle opens. And if we're leaving behind liquidity, we want to know how to apply time with the PDI model. All right, so let's say we have like this buy side level up here, and we have this low resistance liquidity from the PDI model. And so if we're accumulating here from 9:30 or like 9:40, 9:50, 10 to maybe 10:59, what's usually going to happen is that when the new hourly candle opens up, being that 11 a.m. candle here, that hourly candle will manipulate in one direction, breaking out of this accumulation zone, and it'll hit some sort of, key level. And then you'll get that inversion and that PDI to the upside after that hourly candle opens in that corresponding direction. And so the reason I'm telling you this is because if you get in the habit of like maybe waiting for that 10 a.m. open, right? If like 9:30 to 9:59 is really choppy, let 10 a.m. open higher or lower and break out of that accumulation, and then take that high sign from inversion and then catch that distribution. So just know that it is really important that with those new hourly candle openings, they'll usually manipulate and rebalance a range or seek some liquidity and then distribute. So just be on the lookout for that, right? So you don't want to be taking like a PDI model at 10:59 when you have 11 a.m. opening soon, because that's going to help you determine a better narrative for price. So don't be executing trades 1 minute or 2 minutes or 3 minutes before a new hour opens up. And that's really the last thing I'm going to go over with this. That's not like the most important factor, but it is something to note. So I hope you guys really understood the PDI model here. And as you guys know, there's Q&A calls twice a week. So if you have any questions regarding the PDI model or how to apply it, how to trade it, or anything just about it, let me know. We'll go over it together. I'll help you guys build a better understanding of this. And you'll see that each video correlates with the next. So now that you've learned MEC model, now that you've learned PDI model, don't worry if you still don't understand it. Each of these videos coming up is going to help solidify all this information in your brain and really help you master our models, help you master the charts, and just make you guys absolute fucking animals. Anyways, boys, I hope you enjoyed this lesson on PDI, and I'm glad you're able to join the 1% and take some initiative. Now, I'll keep dropping more sauce for you guys. See you in the Q&A calls. Keep grinding these videos. Take notes. Make sure you back test. Make sure you forward test. Make sure you practice everything that we teach you so you can really get better at this. We want you guys to fucking crush it. I believe in you guys. You got this. Send me 3 examples of your PDI model. We'll put a homework tab up where you guys can drop your homework. We encourage you guys to do so. We know a lot of you don't want to be participating in the homework shit, but we advise you do. It's a good habit. So if you can find me 3 PDI models, show me the confluences, right? Mark out the accumulation zone, mark out the manipulation zone, what it manipulates into, that key level, and then show me how it distributes. And yeah, I hope you guys are able to catch freaking bangers left and right with this model. And you'll see, that a lot of my trades are this PDI model. But thank you for watching PDI by Patty, lesson number 2 of the 1%. And I'll see you in some upcoming videos, boys. Much love.